Welcome to this course on Advanced Management Accounting. In this first module, we will explore the nature of management accounting, the value of information in decision-making, and the ethical responsibilities of management accountants. We will also look at methods of cost estimation and forecasting, short-term planning and decision-making, and budgetary control with advanced variance analysis. The aim of this module is to build a solid foundation of principles and tools that allow management accountants to support organizations in making informed and strategic decisions. Section 1: Nature of Management Accounting. Management accounting is different from financial accounting. While financial accounting focuses on reporting historical performance for external stakeholders, management accounting provides relevant, timely, and forward-looking information to managers. The true value of management accounting lies in information for decision-making. Decisions in business often involve uncertainty. With perfect information, managers could make the best decision with complete confidence. However, in reality, decisions are made with imperfect information, that is, information that is incomplete, uncertain, or subject to estimation. Management accountants, therefore, play a crucial role in ensuring decision-makers have access to reliable, relevant, and timely data, even if it cannot be perfect. Equally important is ethics. Ethical standards for management accountants demand integrity, objectivity, confidentiality, and professional competence. These values ensure that information is not manipulated or misused for personal or corporate gain, but instead serves the broader goals of fairness, accountability, and sustainability. Section 2: Cost Estimation and Forecasting. Accurate cost estimation is essential for planning, budgeting, and decision-making. Several methods are used. Engineering methods involve detailed technical analysis of how resources are consumed in production. Simulation models replicate real-world processes in virtual form to test different scenarios. Statistical methods include regression techniques to predict cost based on historical data. Simple regression looks at one independent variable. Multiple regression considers several variables at once, offering more accurate predictions. Learning curve analysis recognizes that as production experience increases, efficiency improves and cost per unit decrease. This principle is especially useful in industries with repetitive processes. Together, these methods help managers predict future costs, evaluate options, and manage uncertainty. Section 3: Short-term planning and decision-making. Short-term decisions often determine an organization's immediate profitability. Key tools include cost-volume profit (CVP) analysis. For a single product, CVP helps determine the break-even point and margin of safety. For multiple products, weighted averages of sales mix must be considered. Under uncertainty, probability analysis or sensitivity analysis can be applied. Risk assessment. Risk can be managed using techniques such as scenario planning, decision trees, or probability estimates. Marginal costing applications. Product mix decisions, selecting the right combination of products under resource constraints. Special orders, deciding whether to accept a one-time order at a lower price. Make or buy decisions, weighing the cost of producing internally against outsourcing. Pricing decisions, determining minimum acceptable prices in the short run. The essence of short-term decision-making is identifying relevant information, cost and revenues that will change as a result of the decision. Irrelevant information, such as sunk cost, must be ignored. Section 4: Budgetary Control and Advanced Variance Analysis. Budgetary control is one of the most powerful tools in management accounting. Types of budgets. Flexible budgets adapt to different levels of activity. Static budgets, fixed for one level of activity, useful for planning but less so for control. Purpose of budgetary control. Planning, setting targets. Coordination, aligning activities across departments. Control, comparing actual performance against plans. Human and motivational aspects. Budgets can motivate employees by providing clear goals, but unrealistic budgets may demotivate. Participation in budgeting can increase commitment. Emerging trends in budgetary control. Enterprise resource planning (ERP) systems integrate budgeting with company-wide data. Activity-based budgeting (ABB) links costs to activities rather than just departments. Zero-based budgeting (ZBB) requires justification of all expenses from scratch. Program budgeting links budgets to organizational programs and outcomes. Advanced variance analysis. Traditional variance analysis compares actual cost with standard cost. Advanced approaches include exposed variances, analyzing after the fact to understand performance drivers. Opportunity cost variances, considering what could have been achieved under different decisions. Variance investigation models help determine whether variances are significant enough to warrant further analysis. In this first module, we covered the fundamentals of management accounting, methods of cost estimation and forecasting, tools for short-term planning, and advanced budgeting and variance analysis. These tools form the backbone of management accounting practice and provide managers with vital insights for operational and strategic decisions.